Hello traders, in today's video I'll be sharing with you 4 straightforward trading strategies that can potentially earn you $300 daily. These methods have all been rigorously back-tested and boast a high win rate, so you can be confident in their effectiveness. The best part is I've outlined clear steps for each strategy, making them easy to follow. After watching this video, you'll be ready to apply these techniques and start trading right away. Let's dive into the first strategy without further delay. Our first strategy takes advantage of what is known as a false breakout to identify trading opportunities. If you're not familiar with a false breakout, let me explain. Imagine you're analyzing a chart and notice the price rejecting a certain level multiple times. You mark this as a support level. As the price approaches this level again, you think, the price has reversed from this support level before, so it might do so again. Expecting a reversal, you open a buy position. As a disciplined trader, you remember to set your stop loss just below this support level. However, instead of reversing, the price dips down, triggers your stop loss, and then reverses back up. This is a false breakout, a tactic used by institutions to trigger the stop losses of retail traders. But with the right approach, we can turn false breakouts to our advantage for high win rate trades. Here's how. First, identify a clear key level. This can be either a support or a resistance level. The key word here is obvious, as you want to find a level that many retail traders are watching, making it more prone to a false breakout. In this example, we see the price hitting a certain level and reversing, establishing it as a clear resistance level. Next, wait for the price to approach this level again and break through it. When this happens, examine the price action closely at this area. Now, you might wonder whether this is a false breakout or a genuine breakout. The beauty of this strategy is that we can profit in either case. Here's what I do. As soon as the price breaks this resistance area, I place a limit sell order below this key level. A limit order is an order to open a position at a specific price. If the price reaches my limit order, the position is opened. If not, nothing happens. This way, if the breakout is a false breakout, our sell order is triggered, and we profit as the price reverses down. If it's a real breakout, the sell order isn't triggered, and we don't lose money. To add another dimension to the strategy, you can also place a limit buy order above the breakout level. This means we're prepared for either direction. If it's a true breakout, our buy order gets triggered, and we profit as the price rises. If it's a false breakout, our sell order triggers, and we profit as the price falls. Of course, there's always the risk that the price moves against our position after triggering one of our limit orders. That's why it's crucial to set a stop loss and profit target once a limit order is triggered. Let's see how this plays out. As the price moves down and triggers our sell limit order, a sell position is opened. After opening the position, set your stop loss at the midpoint of the breakout candle and your take profit at 2 times the stop loss. As you can see, the price continues downward, hitting our take profit target. Now, let's move on to the second trading strategy, known as the PRC pattern. The PRC pattern is a high probability setup that features 3 specific candlesticks in a row: a power bar, a retracement bar, and a confirmation bar. When this sequence appears on the chart, it often signals the start of a strong trend, which we can capitalize on. The concept is that by identifying and trading this pattern regularly, you can achieve high win rates with manageable risk and significant reward. In this video, I'll show you how to recognize the PRC pattern, assess the trade setup, and determine optimal entry and exit points. Let's start with identifying the PRC pattern. This pattern consists of 3 consecutive candlesticks in any direction. The first candlestick is called the power bar, characterized by a large body indicating strong momentum. The second is the retracement bar, a smaller candlestick with the opposite color of the power bar. Ideally, the retracement bar's size should not exceed half of the power bar's body. The third candlestick is the confirmation bar, a medium to large candlestick that closes above the retracement bar. Once this sequence completes, you enter a buy position at the close of the confirmation bar. Now, let's discuss placing entries, stop losses, and targets. When you spot a bullish PRC pattern, like in the chart example, enter at the close of the confirmation bar. Place your stop loss below the power bar and set your target at the next resistance level. Ensure the target is at least twice the risk taken. Conversely, for a bearish PRC pattern, enter at the close of the confirmation bar, set a stop loss above the power bar, and target the next support level. This straightforward, effective strategy can be highly profitable when applied correctly. Let's move on to the third trading strategy. For this method, we're leveraging the Fibonacci retracement tool, but with a slightly different approach than what is typically taught. For those unfamiliar with the Fibonacci tool, here's a brief overview. It's a tool used to identify potential endpoints for pullbacks or retracements. For instance, if the price is trending upwards and then retraces slightly, we can use the Fibonacci retracement tool to predict where the pullback might end. To do this, you drag the tool from the swing low to the swing high. The resulting levels often act as potential support or resistance where the retracement might conclude. For this specific strategy, we focus on the 0.618 and the 50% levels. Although the 50% level isn't a traditional Fibonacci ratio, it is widely used by professional traders. Here's how to trade using this strategy. First, identify a trend followed by a slight retracement, as shown in this example. Next, apply the Fibonacci retracement tool to this price movement. We then wait for the price to pull back to the 0.618 or 50% level and look for signs of rejection at these levels. As the price approaches these levels, we look for the formation of high probability candlestick patterns, such as a pin bar, an engulfing pattern, or a doji. For instance, in this chart, once the price reaches the 0.618 Fibonacci level, it forms a pin bar pattern, indicating a strong buy opportunity. You would place your entry at the close of the pin bar, set a stop loss 10 pips below it, and aim for the next significant level as your target. Let's examine another example. Here, the market is trending downward before retracing slightly. By applying the Fibonacci retracement tool, we see that once the price hits the 50% or 0.618 retracement level, it gets rejected, presenting a great selling opportunity. There are 3 key conditions to follow with this strategy. The trend should be clearly up or down. The market should show rejection at the 50% or 0.618 Fibonacci levels. There should be a confirming candlestick pattern, such as a pin bar, an engulfing bar, or a doji. This strategy is particularly effective on higher time frames like the hourly, 4 hours time frame, and daily charts. Give it a try and let me know your results in the comments section. Let's move on to the 4th and final strategy, the supply and demand zones trading strategy. This method is simple yet incredibly effective, making it perfect for both beginners and experienced traders. So, what exactly are supply and demand zones? These are key areas on your chart where prices have previously reversed sharply. They highlight significant imbalances between buyers and sellers, leading to substantial price movements. A supply zone is an area where selling pressure surpasses buying pressure, causing the price to drop. Typically, you'll find supply zones at the top of price swings. On the flip side, a demand zone is where buying pressure exceeds selling pressure, causing the price to rise. You'll find these zones at the bottom of price swings. To identify these zones, look for areas where the price moved rapidly away, creating noticeable swings. Once you've identified potential supply and demand zones, draw horizontal lines or rectangles to mark these areas on your chart. These zones should cover the range of prices where the sharp move originated. After marking the supply and demand zones, the next step is to wait for the price to return to these levels. This is where you'll find trading opportunities. When the price approaches a supply or demand zone, look for confirmation signals to increase the probability of a successful trade. These signals can include candlestick patterns such as pin bars, engulfing bars, or doji candles. Let me give you a practical example. Look at this chart. You see a very strong upward move that catches our attention. Such a move is likely driven by a large institutional order, indicating a strong demand zone. The first thing we should do is draw the demand zone. Identify the start of the move and locate the basing candle. In this example, this candlestick formation serves as the basing candle, so you can draw the demand zone. But identifying the zone is just the beginning. Next, we need to evaluate its strength. The move should be strong and swift, indicating significant buying interest. In our example, the price moved up quickly, suggesting a large institutional order. Candle size. Large candles within the zone indicate substantial buying pressure, pushing the market higher in a short time. Breakout of resistance. The strength of the move is confirmed if it breaks through previous resistance levels. Freshness of the zone. Fresh zones that haven't been tested before are more likely to hold. Evaluating these factors helps determine if the zone is worth trading. Now, let's 2-to-1 reward to risk ratio. Once a confirmation pattern forms and the risk-reward ratio is favorable, you can confidently enter the trade. The same principles apply to supply zones, making this strategy versatile and robust. If you enjoyed this video and found it helpful, please give it a thumbs up. Don't forget to leave a comment below with your thoughts or any questions you might have. I love hearing from you. And if you're new here or haven't subscribed yet, Hit that subscribe button and ring the bell so you never miss an update on future trading strategies and tips. Thank you for watching and happy trading.